Jim Leach, when I spoke to him, and Ramsey Smith, who you also know, when I spoke to him, they both mentioned this mortality risk pooling.
Yeah.
You said that risk pooling and fees were the two biggest things, and we haven't talked about risk pooling at all. But tell me, where does the big savings come in there?
There's a couple of things there, actually. I mean, the first is, well, there's three places where you get big risk pooling benefits. The first is, if you were an individual and retiring, think you're going to retire in 2008, you may have had a 40% drawdown on your funds. So you either have to take a much lower income during your retirement, or you have to postpone your retirement activity. If you're in our plan, that risk gets absorbed across generations. So people who retired in 2008 got the same as they were expecting, and it worked out fine. Second place is that if you're on your own and you retire at 65, you got this chunk of money, it's got to last the rest of your life. So you can't take a loss, or you may find yourself in a very difficult position. So you have to actually dial your risk down. So you have to take a much higher fixed income component in your portfolio than you would otherwise have.
Yes.
So that actually reduces your return over, which could be a very long period of time, in 20, 30 years. Whereas in our plan, again, because that's absorbed across generations, we can maintain the same asset mix all the way through that period, so we can maintain the return. So again, that makes a big difference. The third place is longevity pooling. And so, if you think of a large plan like ours, we have 380,000 members in the plan, so average mortality becomes pretty predictable. And so in our case, it's about people who live to 65. The average mortality in our plan is about 87. So we know we have to pay people for roughly 22 years, and we can charge people based on that, and so we can charge you less through your working career because we know that outcome's pretty predictable. Whereas if you're an individual, but within our plan, we have, some people pass away shortly after retirement, but a lot of people live a very long time too. So we have members in our plan. The oldest member is 104. And she actually retired in 1976, by the way, so she got a pretty good deal.
Yeah.
But we actually have 72 members that are over 100, and we have 2,500 between 90 and 100. So, people can live a long time. So you, as an individual, you kind of have to assume you're one of those people, because you don't want to run out of money when you're 90, right?
You don't want to be eating cat food at the age of 90.
Right. So in our plan, you're going to get paid for your entire life because that risk is shared across the membership. Whereas you as an individual, you either have to save a lot more money to get the same outcome, or you have to take a lot less money in your retirement in order to make sure it lasts through your career. So just that, even if you assume, you're going to live 5 years longer than the average, I mean, that's a lot of money.
That is a lot. And of those two outcomes, the second one is the one that gets me. You say you could either save more money or reduce your expenditure once you actually retire, because that has huge public policy implications. I mean, the whole concept, when you're going from defined benefit to defined contribution, basically what happens is all of the risk is larded onto the individual, and that individual changes their behavior. And that change is one that actually reduces consumption. It reduces growth in the economy.
Yeah, and so we had a study done a few years ago. It was done by Boston Consulting Group for us, and it was the objective of the study was actually to look at how the distributions from defined benefit plans have impacted local economies. And one of the interesting things that came back out of that study, I mean, they weren't looking for this, but that's what they found, is that there was a very different spending pattern between people that were in defined benefit plans and had predictable income versus people that were not. And so people that were not generally hadn't saved enough during their working career, so became savers in retirement.
Right.
And they're all worried about outliving their money, and there was no predictability as to what the next check's going to be, right? So so they became savers in retirement. Versus people that were in defined benefit plans knew they were going to get a check next month, so spent the money. And so, had this sort of, one has a dampening effect on the economy, the other has a stimulating effect on the economy. But even if you go back to, what we just talked about, that difference between in the working career, putting aside $1.2 million versus putting aside $300,000, I mean, that puts $900,000 back in that person's pocket during their working career they can spend on other things, right? So again, it's stimulative impact on the economy. So, So I mean, I think there's this, that seems to get lost a bit, and in fact that there are a lot of economic benefits to people having predictable income, and again, not taking as much away from them during their working career. So efficiency makes a big difference.
Oh yeah, definitely.